This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi. Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for declines after J-Powell takes a wait-and-see stance on rate cuts amid trade war uncertainty, dashing hopes of a Fed put. And tech leading declines in the US session as the Trump administration curbs Nvidia chip sales to China, and ASML delivers a disappointing report. China, meanwhile, suggesting it is open to trade talks if Trump shows more respect, while the president touts big progress in negotiations with Japan.
It's no wonder that we saw a risk-off session overnight on Wall Street because we already had that pressure on tech stocks. And then you get these comments by Chair Powell. Really, he was asked directly whether he envisioned a Fed put for the markets. He said no. So he really did not seem to be in a rush to help markets, to help the economy and ease policy. Take a listen.
For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks. We understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. We will continue to do everything we can to achieve our maximum employment and price stability goals.
And Shery, it was really that emphasis on anchoring long-term inflation expectations that was key to what he wanted to get the message across as, right, in terms of wanting to avoid even a one-time rise in inflation expectations that could potentially unhinge the employment mandate as well, saying that the Fed needs to balance the dual responsibilities of maximum employment and stable prices, and that price stability ultimately is a prerequisite to that employment goal. Take a listen.
Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans.
So those comments really rattling markets even further, and you can take a look at U.S. futures trading early in the Asian session, really not doing much because, of course, we had that broad pressure overnight. We had also tech stocks losing ground, leading the declines. $200 billion wiped out for Nvidia, ASML. Of course, we have the news about new chip export restrictions to China. We also had disappointing earnings. Today in Asia, we'll be watching TSMC earnings as well for a feel of how that will affect really the broader global supply chains. But it's really not surprising that we saw those haven assets move, right? We had treasuries rising. We had gold also touching new record highs. We had the dollar weakening as well. Take a look on the other side of the trade, how we're setting up for Asian assets as well, because we had the offshore yuan actually strengthening a little bit on the back of that dollar weakness. Also, of course, we had those reports coming that China may perhaps be open to coming to the negotiating table, depending on some conditions that we've heard about from sources. But take a look right now at the setup because the offshore yuan is holding steady. We're seeing Sydney futures to the downside. Of course, Nikkei futures will be watching JGB bonds very closely. We saw the longer dated end really rally and follow treasuries higher after that sell-off that we saw in the 20-year as well. And of course, we are watching the Bank of Korea rate decision today, the expectation for a hold, Heidi.
Such a difficult, challenging time for global central banks, right? When it comes to the US, Shery, we actually did also see US retail sales rising 1.4% in March. This is the biggest jump in 2 years, but that's really being seen as being driven by a surge in car and electronics purchases, suggesting that consumers are scrambling to buy before tariffs come into effect. Let's bring our global economy correspondent, Enda Curran. So clearly some front loading there. And it was interesting. We heard from Fed Chair Powell suggesting that those inflation and jobs labor market goals are going to start moving away from what the Fed wants to see for the rest of this year and eventually come into conflict. Is this sort of the calm before the storm in terms of what we're seeing in the data?
Well, it does feel like that, Heidi. Like you mentioned, it was a robust set of retail sales data, purchases across the board. People were buying cars, obviously, because they're subject to sectoral tariffs. Also buying their electronics, buying their sports goods, buying their construction material for their houses. So clearly people were getting front-loading a lot of what they needed for the year ahead. But to your point, I think a lot of analysts watching those numbers say, look, that's kind of prehistory, pre-trade war, because obviously over the coming weeks and months, that story is going to change as the tariff rates go up, especially obviously from China impacting goods from China. And you mentioned, of course, the Fed Chair Jerome Powell. He was trying to sound something of a sanguine note on the economy today. He wasn't signaling any kind of alarm. He said it's still too soon to make a definitive call on how all of this is going to play out. He didn't give any hint at the need to move policy soon, and he said markets are both functioning and orderly. So he very much tried to calm down market jitters today. But as you say, those retail sales data for March very much already considered to be in the past. It's all about what will you see in the coming months now.
Yeah, and post-trade war, the WTO actually coming out and slashing its outlook for global trade.
Yeah, we had a big downgrade from the WTO today. They're cutting the forecast for merchandise trade by 3 percentage points into a contraction now of around 0.2% in goods trade for the year. And they're pinning that on the US tariffs and the broader uncertainty associated with that. So that's obviously a big downgrade. They're saying trade might rebound next year to 2.6%. But by the way, they say also if the US goes ahead with reciprocal tariffs, then the merchandise trade's good will be even worse. So this is kind of their, maybe their best case scenario at the moment. There was also a downgrade to services trade, which is unusual to see them highlighting that. So clearly a negative read from the WTO, but I think given what's going on in the world of tariffs and a very fractious trade policy underway around the world right now, well, probably ultimately no real surprise that they did downgrade the way they did.
This sort of trade encirclement of China that is part of the US trade strategy. What are we hearing in terms of some of the secondary pressure that we could see through, monetary sanctions or otherwise on China's other trading partners?
Yes, so this is something that's been floating around DC for a while now. There's an idea that actually, the trade war against the US economic allies is all part of a much bigger picture, which is to get everyone on board for a broader push against China. I mean, that's the headline on it. Our colleagues today at the White House reporting that there are some steps that the White House are talking about allies could do. For example, don't mop up extra Chinese goods that they can't sell to the US. Have a look at secondary ways that they can cooperate with the US when it comes to Chinese trade. We know that the Treasury Secretary, Scott Bessent, is kind of a proponent of the idea. He has spoken about it. But needless to say, there's skepticism around how this will work exactly. A lot of people will tell you that the US has already ticked off a lot of its close economic allies, so asking for cooperation will be a bigger ask than it was. And ultimately, we're very early in all of this. We still don't have deals with allies. We had President Trump tonight saying he made big progress in the talks with Japan today here, but we don't have anything concrete. So yes, it's an idea. People are talking about a grand strategy of encircling China, but it's obviously very early in all of this.
Bloomberg's global economy correspondent Enda Curran there with the latest on those trade tensions. We continue to watch chip stocks as well because U.S. semiconductor names had a rough day as new curbs on Nvidia sales to China and a disappointing report from ASML dimmed the outlook for the sector. For more, let's bring in Bloomberg senior editor technology Nick Turner. Nick, even smaller AMD now seeing a charge of as much as $800 million on these new restrictions.
Yes, AMD sells kind of a version of the chip that Nvidia offered in China, and it now essentially can't sell that either, so it had to write off some money. Not as much as Nvidia, just because it's a smaller player in that market, but a bit of money nonetheless.
So we're also looking ahead to TSMC earnings, right? What are we looking for in terms of that conference call and obviously their views as to what's been happening with these markets, but also some views towards what's going to happen with Intel?
Yeah, I mean, I think the numbers are probably going to be pretty strong, so it's more maybe about what they're seeing in the future. The ASML report earlier was pretty negative, so I think people are worried that the industry is kind of taking a turn for the worse, and certainly some of these steps in terms of tariffs and restrictions on chips are not helping. So I think people just want to get a better picture from TSMC, which is, the biggest actual manufacturer of chips and has, a wide range of blue chip clients and really can give a picture, you would think, of what's going on in the tech world and chips specifically.
Nick, how much of a pressure point are these new restrictions at a time when we also, of course, are expected to see tariffs on the broader supply chain, at a time when there had been already doubts about the level of investments that you would need that could potentially pay off on all of this hype over artificial intelligence? How bad could this get for the broader sector?
I don't think the restrictions that apply to NVIDIA's H20 are necessarily a huge deal in and of themselves. I mean, I think some people see them as just kind of a closing a loophole. NVIDIA created this chip essentially to sell into the Chinese market so that it met the restrictions that were imposed in the last few years. Now it's kind of back to square one in terms of it doesn't have a product that works in that market. Now, China is the biggest chip market overall, and anytime a company is sort of shut out of it in a significant way, that's a big deal. And obviously investors don't like it, as you can see from the shares today. But I don't think that issue in and of itself is really kind of going to be a source of massive contagion for the rest of the tech industry in terms of weighing on results. It's just maybe sort of part of a bigger ominous picture.
And is that bigger ominous picture sort of goes to what Nvidia has said in the way that they've opposed to this framework, which is that it ultimately weakens American companies and ultimately kind of just incentivizes China to beef up its own tech, right? Is that sort of the possibility that we're looking at here?
That's certainly Nvidia's view and the views of some others that this is going to backfire. I think either way, obviously, it's increasing the alienation potentially between China and the U.S., and it makes it harder to sort of see what's the point where a company like Nvidia or some other chip companies are able to sort of get back into that market in a way that everybody's happy with.
Bloomberg's Nick Turner there. Well, China is said to be open to trade talks with the US if Washington shows respect and takes a more consistent position. For more on this Bloomberg scoop, our China correspondent Min Lo joins us now. So this idea of showing respect, having a consistent position, I guess how realistic are these conditions? Because it's not even that we've heard, disrespectful comments just from President Trump, but also from other senior members of his administration, namely the vice president.
Yes, and I guess this is the clearest clues yet that we have of what China wants to see before agreeing to trade talks. And as you said, wanting the U.S. to show respect, that includes reining in some of these disparaging remarks that U.S. administration officials have said. No specific examples were named by our sources that Bloomberg has spoken to, but I can think of that J.D. Vance comment about Chinese peasants that the Chinese Foreign Ministry has publicly responded to, calling them ignorant and disrespectful. And the idea is that Beijing believes that Trump has sufficient, in fact, tremendous power over his administration to be able to rein in or at least disavow some of these remarks, and if not, the assumption is that Trump actually condones such behavior. And the other thing that China wants is for the U.S. to appoint one point person who can oversee talks between U.S. and China, and this person must be able to speak with Trump's authority. And because there has been a lot of lack of clarity over what the U.S. position is, obviously different administration officials have said different things in the past, and so China wants this point person. They understand that Trump appears to prefer leading these discussions in a leader-to-leader meeting, but China's preference is for both sides to have that point person overseeing discussions that would eventually culminate in that leaders' summit. So they disagree about the process of going about negotiations as well. And the third thing that China wants is for the U.S. to at least be willing to address some of China's concerns, particularly when it comes to Taiwan, to maintain the status quo there. Sources telling us that China will not take provocative actions but will respond when provoked. And the other concern is the belief that these Washington policies are really targeted at suppressing China's modernization. And when it comes to this, it's really not clear at this point. It just shows how far apart the two sides are when it comes to their starting points when it comes to this negotiation.
Yeah, there's a lot of confusion from trading partners, from China, from everyone that's dealing with President Trump about what exactly he wants out of these negotiations, right? There's even confusion at this point in Beijing about how much some of their goods are actually being taxed in the U.S. What's this about?
Yes, some media have reported that China could be taxed 245% by U.S. customs, and this confusion came about because of a White House fact sheet that indicated that Chinese imports will now be taxed at 245%, but the White House has come out to clarify that this is not an escalation of the trade tariffs. The tariffs remain the same, 20% fentanyl related, and then 125% reciprocal tariffs, a total of 145. The 245 came about because if you consider some of the pre-existing tariffs, especially the sectoral tariffs, think about EVs that were taxed at 100% under Biden's administration, the cumulative tax could go up to 245%. And so that's where we got that number. And the Chinese side has acknowledged they are aware of the level of cumulative tariffs, and they reiterated their point that they're going to fight till the end.
Bloomberg's China correspondent Min Min Lo there. Coming up on the Asia trade amid this very complex tariff environment, K2 Asset Management joins us next to talk investment strategy. Morningstar tells us why they don't see a recession on the horizon. Plus, we discuss how trade barriers are impacting the tech sector with IDC. Much more ahead. This is Bloomberg.
Take a look at how we're setting up when it comes to this Thursday session. Of course, for a number of these markets, particularly here in Sydney, I should say, this is the last before we get that 4-day-long weekend going into the Easter holidays. But looking like a pretty sluggish session so far, 0.3% lower as we see most Asian equity futures on the back foot, tracking those losses in the US session after we had the fading expectations of the Fed put, right? Fed Chair Jay Powell warning that there could be an undermining of those dual mandate goals. Let's bring in George Boubouras, who's the Managing Director for Research, Investments and Advisory at K2 Asset Management. To be fair, I think the expectation perhaps should have been more muted in terms of what we'd heard from Fed Chair Powell. He's always been quite cautious in terms of watching the data and looking at the implications on inflation from these tariffs and the trade war. Were you surprised at all? And does this kind of dent the cautious recovery that we've seen after all the recent volatility?
Good morning, good to be here. In part it does dent a little bit, but in reality the whole speech is quite reasonable. It's cautious outlook, it's what the Fed's got to do, it's balancing multiple scenarios. I think Fed Powell outlined that quite clearly. Where I think most people in the market will be sympathetic is that it's going to be a one-off VAT style shock on prices, but in reality there is some demand destruction within the economy. But the problem the Fed's got, and the problem we've all got when we're looking at data, is that the PMI surveys reinforce that they're pre-purchasing right across the board in anticipation of tariffs because of supply chain planning from the procurement side of things. And obviously they're well drilled from the pandemic in doing this. That is really making the economic partial data stronger than anticipated, and that's with the US already robust, and we're going to have to see the demand destruction on the other side. So as we go towards mid-year, the second half, you see that demand destruction. And that's what the Fed's trying to communicate to us, saying on the one hand we've got the economy running quite well, but we're going to see some pockets of weakness and amplified going forward, and the leading indicators are very much difficult to sort of give us true guidance at the moment.
If you expect resilience eventually coming from the U.S., does that mean also a stronger U.S. dollar? Because there's been a lot of skepticism about its safe haven status right now, given the trade tensions.
More short-term US dollar status quo and weakness towards the second half of the year when there's more predictability on the demand destruction of the economy. How many Fed rate cuts were probable? Is it 2, 3 or 4? We think 2 to 3. And what happens with the tax cuts coming through is very much a big tailwind. So once you see that, we see weaker US dollar for now, stronger towards the end. But the reality is the world doesn't have an alternative. At the margin, yen and euro have been benefiting, and that happened in previous events from 2016 in the first tariff, which are quite minor wars at the time. But at the margin, that US dollar weakness. But reinforcing the point, the world is not ready to move away from US dollar, and it's not prepared for that. And the world is not ready to move away from the status that the risk-free nature of US treasuries in portfolio construction. Those two are the structural scenarios going forward. And if we were to move away from that, we haven't even seen volatility. That's yet to come. But the reality is that that's set in play, and at the margin, yen and euro will continue to benefit. But again, US dollar strength by year end, once we see the demand destruction coming through, and the reality of what sort of tailwinds are coming from Fed rate cuts, and what sort of tax cuts at the household and US corporate level coming through later on this year.
You don't buy the argument that China is a good diversifier, that because of the nature of their government, they can move policy very quickly?
They are a great diversifier, and but very quickly we play China through exporters to China, and we play China via economies that are linked to them, like Germany. That's how we'll play it. But the Chinese economy, the domestic demand cycle, the balance sheet recession, the property construction collapse is quite severe. So they're in a bad way, and they do need some stimulus. So in reality, the Trump policies is bringing Germany out of 2 years of recession, and possibly, if China can do a proper, not a mini bazooka, but a proper, whatever it takes, Mario Draghi, exponential, whatever it can to help domestic demand take on those apartments that are not completed. If they can build that around, they can make domestic demand a bigger component of the Chinese economy, and that could be the saviour for global GDP.
But I keep hearing the skepticism in your voice. Is that why you don't necessarily like emerging markets, according to your notes?
Yeah, very underweight emerging markets from the March quarter. We had to take an underweight from risk assets, and looking at the portfolio, the hedges within our puts within exchange traded than the OTC with the CDSs, they've all worked so far. The problem we have, and hence the skepticism in essence in my voice, is that the problem is that insurance going forward for our portfolios are much more expensive than where they were at the beginning of the year. And that's the dilemma we've got going forward with pockets of volatility coming out. And as we look at what Beijing does for its potential policy stimulus or non-stimulus, and what the US does. So the dilemma we've got is the next pockets of vol for the rest of the year, insurance across our portfolios are more expensive. And that's the thing to reinforce here.
George Boubouras, always great to have you with us. We ran out of time, but we want you back, Managing Director of Research Investments and Advisory at Kit2 Asset Management. We have more ahead. This is Bloomberg.
Take a look at how US futures are sort of coming to terms with really the lack of a Fed put, right? We had those comments from Jay Powell really sounding quite measured in terms of the willingness of the Fed to do anything at this point, even acknowledging, though, that the goals of when it comes to inflation as well as the labour market are likely to move further away from what the Fed would like to see, and potentially even that mandate coming into conflict at some point this year. At the moment, we're seeing futures looking pretty flat. At the moment, we did see some downside losses in US stocks in the overnight trading session. Nasdaq 100 futures also looking like we're seeing a little bit of upside after, of course, further pressure when it comes to the big chip makers, Nvidia amongst them, on these China risks and the charges associated with that. We're also watching treasuries as well. Here it is looking like at the start of pretty thin trading as we head into that Easter long weekend, but treasuries in that session rallying as we see the Fed focus remaining on price stability. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to some of the big movers to the downside in the overnight session. We're seeing Nasdaq futures looking a little bit more positive, but not so when it comes to the last traded action when it comes to the likes of Nvidia, AMD and ASML as well, all looking pretty muted. We saw Nvidia saying that they see that $5.5 billion hit from the new China curbs from the Trump administration on chips, on the H2O chip to China. It would have really a pretty significant ramification across its product line as well. So all of this being part part of course, Washington's further efforts to limit those AI and chip ambitions from Beijing. Let's get some analysis now on the impact of these latest measures. Joining us now is Emily Benson, who's a head of strategy at Minerva Technology Futures. She was previously a senior advisor at the US Department of Commerce. So, Emily, let me get your thoughts on what this framework looks like at the moment. Is it meaningfully problematic when it comes to obviously companies like Nvidia, but perhaps for the broader sector as well? And how much does it really just push Beijing to further its goal of tech independence?
Well, thank you for having me. That is certainly one of the core questions that's been for quite a while, emanating especially from the first Trump administration, about how to weaponize the trade toolkit in order to exact certain national security and foreign policy outcomes. And while today's announcement that the U.S. will now require additional licenses on certain chip exports to China may seem like a much stronger posture from the United States, it very much fits into part of a broader strategic doctrine that the United States has pursued, again, starting in Trump, continuing with Biden. And now we see a much more forward-leaning posture that's aiming to curb additional chip flows to China. This, of course, is based on the assumption that U.S. chip exports can give China the leading edge, especially when it comes to potential military end uses of critical technology. This, again, is an opening salvo of the Trump administration to say we mean it, we intend to enforce it, and we're taking a much firmer posture on the moat that we're building. To borrow a term from Jake Sullivan about the small yard, high fence, the fence is growing, and so is the yard.
I wanted to ask about the TSMC case study, right, in terms of the overtures made by the company to try and get to US production, that sort of level of enthusiasm, and then the response incrementally from the administration. What does that tell you about sort of the challenges that are being faced even by companies, foreign companies that, you know, are willing to play ball here?
So what I do in my personal capacity at work every day is help companies navigate this new changing environment. And we certainly hear a lot of questions from major companies about, do we invest? Do we double down? Do we go to a third market? Do we double down on the European market, for example? And the case study that I always come back to is TSMC, because TSMC maintains leading edge production with a lot of capacity that is still based in Taiwan. And the administration, and also to a degree under Biden, has really attempted to get Taiwan to move parts of that production, particularly at the advanced levels, back to the United States, so that there is a more resilient and secure supply that is sourced domestically. Taiwan, of course, came out with this very splashy $100 billion announcement early on in an attempt to seek ultimate tariff relief. The administration, in turn, has said, actually, we're still going to apply tariffs, even though you have invested here. There are some conversations underway now about a potential chip carve-out, but that is certainly still under construction. But I would anticipate that a lot of additional foreign countries are really looking at the TSMC example to see where they can negotiate and gain certain concessions.
Yeah, I mean, given all of the tariff announcements, this chart on the Bloomberg also showing that already 2 analysts have cut their ratings for TSMC, a company that, of course, we've been watching for years as really having a lead in this sector. But given the difficulty knowing what exactly the Trump administration wants, how difficult is it for companies like TSMC, other Asian companies like SK Hynix, Samsung? We know that, for example, Hyundai also announced billions of dollars in investments in the U.S., and they just got hit by auto tariffs as well. How difficult is it to prioritize business for these corporations?
So corporations are contending with a lot of different factors right now. One, of course, is the certainty of the U.S. marketplace. And this is sort of an inconvenient truth for skeptics of the agenda overall. But a lot of companies have indicated a serious willingness to play ball. And that is an indication that the U.S. is still very much investable. It's a very diverse marketplace. And it's a good investment over the long run. And we certainly have seen companies doubling down on that. Where I think the administration may encounter some implementation difficulties is on the tariff front. So companies have had a very high degree of certainty under international frameworks that the goods and services they exchange are happening at relatively efficient levels. If we bring tariffs into that equation, it makes the imports of certain parts and components into finished goods much more expensive. So if you're a hyperscaler or you're an automobile manufacturer, all of a sudden the cost of manufacturing is increasing, and that's not even taking into account the higher labor costs here in the US. And so I do think that over time, companies will have to contend with a package of sweeteners. And the Biden administration certainly was very effective at putting forth these large spending mechanisms, but we have to see how that will come out of the Trump administration.
Is that the best way to deal with this also notion of expanding areas of the global economy that apply to national security, economic security? We have seen the U.S. really look into not only semiconductors, but now pharmaceuticals and, of course, critical minerals as well.
So part of the problem with the doctrine overall that we are learning about collectively as a global community after the COVID-19 supply chain crunches is that, to a degree, a lot of the inputs that we receive from foreign partners are critical. Everything now keeps the lights on, and that's particularly true in a digitally connected environment. And so it's been a challenge for administrations throughout my adult life, and this spans both political parties, to really create a clear definition of where to draw the line. The problem with drawing the line and saying, look, anything that exceeds this line is that at some point it will push foreign indigenization and innovation in exactly those sectors, and that in turn will create greater competition in the marketplace. So we'll certainly have to see how that plays out.
Emily Benson, good to have you with us, Head of Strategy at Minerva Technology Futures. Chinese EV maker Xpeng now saying that it's still optimistic about its overseas ambitions, hosting its first global launch with the new X9 minivan in Hong Kong. Founder and CEO Hu Xiaopeng spoke exclusively with Bloomberg about the car maker's localization plans and growing global trade challenges.
对于一家企业来说，我们期望是稳定性。
For a company, we expect stability. In any case, stability will bring political, economic, and cultural certainty. And only then we can formulate a clear corporate strategy. So we deeply believe that stability is above all. In fact, Europe is the focus of Xpeng's globalization strategy, and we will strengthen our business in regions including Southeast Asia, the Middle East, Central America, and South America. However, we still hope that one day more Chinese companies will be able to expand their businesses into other countries, including North America, under stable policy conditions.
We know that the Chinese and the Europeans have restarted talks about this minimum price mechanism, potentially to replace the tariffs, which can go as high as 45% into the EU. How would that affect your plans for the European market? Potentially, would that mean scaling back on the immediate need to have your own production bases in Europe?
We have noticed this news, but I believe the talks are still in the early stages. For me, the certainty lies in the tariff policies that China and Europe clearly implemented last year. As we Xpeng, we firmly believe that only through localization in areas of localized R&D, service, manufacturing, and sales can we ultimately achieve comprehensive globalization. So we are working on how to better implement our localization strategy in Europe and other regions. In the future, we will announce our localization strategy in certain countries and expect to have more localization strategy in more markets.
Let's talk about chips, because you need these chips across the board, whether it's your flying cars, your humanoid robots, your industrial robots, and of course, self-driving robo-taxis and the like. How critical was it to build these chips in-house, not necessarily rely on the Nvidia Thor chips and create your own Turing chips? Was this because it's cheaper? or because of export controls, or because you have to meet certain requirements from the Chinese government that more chips in these kind of products need to be made in China?
实际上，像 Tesla、像 Apple 一样，他们都正在研发。
Actually, companies like Tesla and Apple are developing their own chips, and they're certainly collaborating with Nvidia and many other chip suppliers. According to our research, each Xpeng vehicle contains 5,500 chips from global suppliers. Given the large number of chips, the reason that Xpeng is working on the in-house chips is that we hope we can leverage our own capabilities. For instance, if we aim to achieve autonomous driving and use global autonomous driving systems, we need chips that can help our autonomous driving perform better in conditions like nighttime and glare. We hope to maximize the performance of the chips, and at this point, there is a huge value of customized chip. So in the future, we believe we will collaborate with many chip suppliers, including Nvidia, while continuing to focus on developing our own customized AI chips.
That was the Xpeng CEO He Xiaopeng there, speaking exclusively with Bloomberg's Stephen Angle. Take a look at what we're watching when it comes to commodities, as of course we see sort of a bit of a deflated market elsewhere when it comes to risk sentiment, largely on account of the sort of muted response that we had from Fed Chair Powell about still watching and waiting and not looking to make any massive moves that could be construed as being a Fed put, right? This is a picture when it comes to oil. We're seeing crude rising a second day, largely on account of the US cracking down on Iranian supply, the US vowing to reduce Iran's energy exports to zero, also a sanction of a second Chinese refinery as well in relation to Iranian crude. We're seeing a little bit of downside when it comes to iron ore. Gold, after hitting a couple of record highs this week, we're seeing another fresh record as both those Powell comments and the escalation of the trade will continue to fire up haven demand. More ahead on the Asia trade. This is Bloomberg.
President Trump says negotiators have made big progress in a meeting with Japanese officials seeking a deal to avoid higher U.S. duties. You can see the Japanese yen strengthening a little bit against the U.S. dollar. Of course, we've been watching for potential strength if the FX rate was at all discussed in these negotiations. Our Tokyo Bureau Chief Isabel Reynolds joins us now for more. Of course, we're still expecting the results of these talks, but what do we know so far?
Yes, well, the developments so far have already been quite extraordinary. As you know, Japan's negotiator, Akazawa, he's been the focus of global attention, really, because he's been first in the line to try and get a reprieve from these global tariffs. He was preparing for talks with the Commerce Secretary and the Treasury Secretary. While he was on his way to Washington, suddenly Trump announces, oh, I'm going to be part of these negotiations. So that must have been rather a shock for him. It's rather unclear what actually happened in the end, but what seems to have happened, in fact, is that Akazawa went to the White House and had brief talks with Trump ahead of the actual negotiations that he'd been preparing for. And after that, Donald Trump, as you know, put out this message saying that there'd been great progress. We have no details on what exactly that progress was at this stage, and we're waiting for Akazawa to speak to the media in Washington. That could happen any minute now.
I want to talk a little bit more about what exactly could have been on the table, but before that, tell us a little bit about Akazawa himself, because of course when Prime Minister Ishiba came in, we had these doubts about whether he was really good in diplomatic enough to be able to really win over President Trump. But Akazawa himself seems to have been a little bit unnerved by the fact that he was appointed as a chief trade negotiator.
Yes, he probably was a bit of a surprise appointment to that particular post. I mean, there were other people who had more experience in trade negotiations who people might have thought were more obvious choices, such as perhaps Toshimitsu Motegi, who's known for his very tough negotiating stance, has actually been singled out by Donald Trump as being a good negotiator. So yes, Akazawa-san, he's a very close friend of Ishiba. They both come from the same area of this country, this rather sort of uneconomically developed place in the west of Japan. And he hadn't been seen as a particularly sort of high flyer until this point. But I think because of his close relationship with the Prime Minister, that may give him some leverage in these talks. And we'll just have to wait and see. I mean, Mr. Ishiba actually fared relatively well in his talks with Donald Trump, so we never know how this might pan out in the end.
Yeah, one former trade negotiator on the US side saying that, if you think about on-the-job training here, right, it's such an interesting dynamic. But do we know much about what will be sort of sought on the table from the US side in terms of what they want in exchange for removing those tariffs?
There have been all sorts of mixed messages about what they might actually want. From the Japanese side, obviously, the ask is very obvious. They want all these tariffs removed. They're subject at the moment to the minimum 10% tariff. Also, their vital car industry is subject to 25% tariffs already. And of course, they want to get away from the prospect of having 24% tariffs across the board. On the US side, as Shery mentioned earlier, the issue of Forex is going to be a very one that's very closely watched. Is there going to be a lot of pressure from the US for Japan to strengthen its currency? If so, that could have a big effect on the market. And even if it's not mentioned, that could have an effect on the market. Beyond that, Donald Trump has talked about tariffs. The fact is Japan does not have many tariffs on its imports from the US. For example, if we look at the car industry, the US exports almost no cars to Japan, but that's not because there are tariffs in Japan. That's simply because the US is not producing the types of cars that the Japanese consumer wants. So this is not a problem that the Japanese government can solve very easily. So we could look at other issues. We could look at perhaps the US asking for more money for the troops that it posts in Japan. That's a potential issue that could come up. It could be pushing for more investment, perhaps in gas investment in Alaska, for example, and that's something that Japan would be prepared to consider, I'm sure. And what is the end game here? That's still not clear, but something that has become more and more to the fore over the past few days is this an attempt to kind of box in China, to work with allies, to restrict trade with China? And again, this is an issue that will be very difficult for Japan. China is its biggest trade partner. How far would it be prepared to go on that? We don't really know.
I mean, try to fit one of those F-150s into Japanese streets, right? I mean, that's not going to happen anytime soon. Isabel Reynolds here, our Tokyo Bureau Chief, as we await Akazawa now speaking in just any moment with some of those results from the trade negotiations, Haidi.
Yeah, and when it comes to South Korea, of course, in a fairly similar position when it comes to these negotiations. But it was interesting, I thought, that we heard that that the finance minister in South Korea told lawmakers that they're actually in no rush in terms of rushing these negotiations with the US, that they would basically be preparing for what Washington will request, and that final decision will be made by the new government. Taking a look at Kospi futures, pretty unchanged at the moment. We saw quite a lot of pressure, of course, on account of the sinking in chip stocks, expecting more pressure today, given also with Nvidia and ASML in the previous session in the US. But of course, it is also a BOK decision day. The expectations are, of course, for a hold for now, but that tariff risk looms ever large. Let's get more on that decision. Our Seoul Bureau Editor Denny Thomas joins us now. So, Denny, what are the main factors that we're going to see the BOK really try to balance today?
Yeah, so as you said, the expectation from the majority of economists we surveyed is that the central bank will hold rates steady today. I think two factors come into play. One, which has been pretty volatile, and it fell to 16-year low last week, although it's recovered from there. And also, there was an unexpected rise in inflation. So those are the two factors that the Bank of Korea may consider while it keeps the rates on hold. But equally, it's going to be a difficult decision because the rest of the economists do believe that there is a chance that the bank might cut rates by 25 basis points. So look, there's a lot at play, but overall, the kind of the expectation is that it will be hold for this month at least.
Yeah, I mean, the Bank of Korea walking a very difficult line, right, given, of course, the financial stability concerns in the country as well. So what will be a key message that the governor needs to send today?
Yeah, so I think it's very clear that the economy is, the growth is slowing. And even before the tariffs came to slam Korea, the political crisis, as you know, has been weighing on the economic growth. So there is all reason for the central bank to ease the rates. But I think what will be a clear message this time will be, look, May is a kind of a slam dunk, and people and the governor and the team will come out and very clearly say that we are kind of ready to cut rates in May, which also gives the policymakers a somewhat bit a clearer picture of what these trade negotiations will bring. As you said, after Japan, I think Korea is among one of the first countries that is kind of keen to have a trade deal with US, even though there are mixed pictures in terms of how rushed and how much they want to cave in. But clearly, whatever time the central bank can buy in terms of understanding where these tariffs are going to settle, that will make life easier for the policymakers. And probably that is a key message that, look, we are ready to help, but we want to also see how the tariff picture plays out.
Yeah, Bloomberg Seoul Bureau editor Danny Thomas there, and perhaps we're seeing some indications of how at least the first salvo of President Trump's tariffs are playing out. In Japan's trade numbers coming in right now, March exports rising only 3.9% year-on-year. That's below economists' expectations and a big slowdown from that gain of more than 11% in the previous month. Of course, we know that the tariff campaign has already started disrupting commerce with the introduction of high tariffs on steel and aluminum. When it comes to imports, year-on-year growth of only 2%. We're also seeing a more sluggish demand picture across Japan. The trade surplus now at 544, but you adjust it and you're actually seeing a deficit of 233.6 billion yen. This all coming at a time when those exports to the U.S. have continued to rise, but at a modest 3% gain year-on-year, and to China, contraction of almost 5%. This is Bloomberg.
Checking some of the stocks to watch when trade opens in Australia, Korea and Japan shortly. We are watching miners. BHP's reported copper output climbing 10% in the third quarter, while output from its Australian iron ore projects remains steady. We're also watching Santos reaffirming its production forecast for the full year. Also tracking chip stocks for a second day in South Korea and Japan after the new US restrictions on Nvidia's chip exports to China, as well as the reaction we saw overnight in the trading session to a disappointing report from ASML as well, dimming the outlook for the sector. So we're expecting to see another day of downward pressure when it comes to the chip and tech related names here in Asia. Of course, it is also BOK decision day that we'll be watching out for. They are expected to stay on hold for now. That weight of the tariff risk will be seen against GDP, though, looking for support when it comes to Korean bonds.
This is the Asia Trade. We're counting down to Asia's major market opens after a risk-off session overnight on Wall Street. We're currently hearing from Japan's chief trade negotiator Akazawa now confirming, Haidi, that he actually spoke to President Trump. That Trump actually told him that Japan is a top priority in these negotiations, saying that both sides will try and reach an agreement as soon as they can. They will conduct the next talks within the month. The reason we're watching this very closely, he's the first one among trading partners to go to President Trump to try to get an agreement.
Yeah, such an interesting dynamic too, because on the one hand, right, we were just saying that he's relatively inexperienced. That could add an interesting dynamic to those talks, but we also know that he's very close to Ishiba as well. So watching very keenly. No doubt South Korea also watching keenly, right? BOK decision day. In the meantime, the finance minister saying that they're not in a rush when it comes to getting these trade negotiations going.
Akazawa actually wants to have the leaders of both countries come to an agreement, and that Japan is still requesting a review of those tariffs that President Trump is now threatening to impose. And of course, the auto tariffs have now gone into effect. He's grateful that President Trump met with him directly. Take a look at how the Nikkei is coming online. Not doing much at the moment, but you have the topics under a little bit of pressure. Of course, we had the pressure in the overnight session. We're watching JGBs very closely because the longer dated bonds actually rose closing the previous session following Treasuries higher. We had another rebound in the overnight session. We had Japan's March exports as well coming just a few minutes ago, rising 3.9% year on year. But this was really a big slowdown from double-digit gains in the previous month, also coming in below expectations. And of course, we'll continue to watch what Akazawa tells us about the results of those trade negotiations. One point we have to watch, they did not discuss currencies this time. This is a very important point because some analysts thought if President Trump makes an issue with the Japanese yen, that then we could see a lot of volatility. You can see the Japanese yen weakening a little bit against the greenback. Take a look at how the Kospi is now setting up. You mentioned, of course, the Bank of Korea rate decision coming up as well. We have seen that pressure coming from the semiconductor side of things. Of course, we do have more signals coming from the U.S. administration that they will try to close any loopholes that they have on those chip exports to China. You can see the Kospi still gaining 0.3%, and the Korean won weakening against the U.S. dollar as we head towards a BOK rate decision. No change is expected this time around, Heidi.
Let's take a look at how we're setting up for, it is the last trading day here in Sydney before the Easter long weekend break. So we're looking pretty muted, potentially some pretty thin volumes given that state of play there. Looking pretty flat as we get online for the S&P, at the ASX 200, I should say. We did see a pretty muted session in the previous trading session as well, looking like it could be more or less unchanged as well to start off the day. The Aussie dollar is seeing a little bit of weakness, but still under that 64 US cent level, which is an improvement from the recent levels that we've seen in the depths of the really risk-off sell-off that we saw. Treasuries are looking like this, and we're also watching Australian bonds as well, set to gain ahead of some March unemployment data, and we'll get sort of a view as to whether unemployment rose. The rate is expected to tick up to 4.2% in March from 4.1% in the month prior, and looking to see if that has any implications for the RBA. Shery.
Joining us now is Lorraine Tan, Director of Asia Equity Research at Morningstar, to discuss all of the latest developments and on trade, on tariffs, and how they can affect the markets. Because right now we are just watching the Japanese yen as it continues to weaken against the U.S. dollar. Of course, we just heard from the chief trade negotiator of Japan that currencies were not discussed. Of course, we're watching the U.S. dollar on the other side as well, Lorraine, because there had been some skepticism about perhaps a reserve currency status of this currency given this ongoing trade war. How do you factor these currency fluctuations into your portfolio allocation?
Yeah, so basically we just have to watch, just watch out for the views that, we would expect a gradual strengthening of the yen over time, and that partly reflects a normalization to where it had come from, dropped from over the past few years. The also anticipation that the BOJ will still keep interest rates on a relatively higher level. So those couple of factors in terms of the yen. Hard to see, where the renminbi is going to end up, but, obviously it has come off, and we kind of expect it to stay at the weaker level for the time being, given the uncertainties.
Uncertainties that perhaps in a way cannot necessarily be quantified so far, right? So when it comes to perhaps the tech sector that's been one of the big gainers in the past couple of years on this hype over artificial intelligence, how do we know when we could see a bottom here?
Yeah, I really can't begin to say what's going to come out with the chip tariffs. What we do feel is that there will be impact basically on the greater impact is obviously going to be felt on those companies with lower margins. They have less ability, obviously, to absorb any incremental costs or any incremental challenges. So in that sense, it's going to favor still some of the leading semiconductor chip companies like TSMC, et cetera. A couple guys there who will probably be able to buffer these shocks a bit better. I will say, however, that in terms of market performance, in Asia, the Asian markets that we look at anyway, they've actually recovered basically more than half of their losses. Now, there are certain sectors that are still very weak, and that's mainly energy and financials. But the tech sector has actually come back a fair bit.
Some of the sort of opportunities that you see that are not exposed to tariffs. Can you talk us through those? Because a couple of them are actually in the China and Hong Kong markets.
Yeah, so prior to the tariffs, I mean, we've been saying that the China market is relatively undervalued. Given the recent pullbacks, it's more attractive, but we still prefer the names that are relatively sheltered. So this includes Tencent, Innovent Biologics. We think both companies are going to be still focused on what's going on domestically. We anticipate that there's going to be some fiscal expansion by the Chinese government still that's going to boost domestic consumption. But having said that, I mean, when we look at Innovent on the healthcare space, has very little direct impact from the tariffs. It's got a healthy pipeline, and it's seldom that we get an opportunity to buy the shares, but the pullback does make it more attractive. Tencent, again, a big cap name, doesn't have an ADR, so it's going to be absent from the concerns over potential delistings of Chinese companies from U.S. markets.
Muted kind of session.
Sorry, go ahead.
Sorry, continue.
Oh, no, I was just going to mention a couple other names that we like. As I mentioned, financials are one of the sectors that were hard hit from the recent decline on, obviously, credit risks. But Dai-ichi Life is actually one of the companies that's fallen the most. And we think that, the market is obviously forgetting that it's a little, it's been able to become less sensitive to macro factors and interest rates. So we think that that's relatively undervalued as well.
I did want to ask you about pharma, because this is clearly one of the areas where the scope for tariffs could be expanding, right? Do you see opportunities or really just downside?
At this point in time, we think there's risk to certain companies. So, for example, those drug companies that export more to the U.S., that includes Takeda in Japan, could come under a little bit of pressure there. I think it impacts the generic drugs more so than, basically the high-end drugs, because obviously replacements or substitutions are more difficult. But in terms of some of the healthcare names, the pharma names that we do like, besides Innovent, we also like Daiichi Sankyo. So we think that the share price reflects most of the downside risk, and it's relatively less impacted to the U.S. markets.
When it comes to the US markets, obviously some of the disappointment that we saw overnight was this reality check that the Fed is not going to be swooping in with, a so-called Fed put, right? Does this kind of change the broader view at all, given that Fed Chair Powell has been, fairly cautious and reasonable in his rhetoric the whole time?
Yeah, I mean, obviously, the Fed isn't going to want to have the market second-guessing its moves, but we actually do think that the Fed's going to have to cut rates probably a little bit more aggressively than we would have originally anticipated. So we are looking at interest rate cuts starting from basically the second half of this year. We actually think the U.S. GDP growth is really going to slow, to sub 1%, probably between 0 to 0.5% thereabouts, between the fourth quarter and the first half of 2026. So although we think that it may not enter recession, the growth will be very slow. And part of that's going to be, avoiding recession is obviously going to come through the Fed cuts.
Lorraine Tan, good to have you with us, Director of Asia Equity Research at Morningstar, as we continue to watch some of those big movers in the Asia session, and of course chip makers in focus after we saw Nvidia and ASML wiping out over $200 billion in market value already with those new export restrictions that will affect not only Nvidia but also AMD, which is now expecting a charge of as much as $800 million. And this, of course, coming at a time when we do have TSMC earnings to watch today. We'll be watching what TSMC says about these tariffs and the new business environment. You can see SK Hynix, one of the big losers, of course, are a big supplier to Nvidia. Trade negotiations ongoing. We're also hearing from the chief Japan negotiator that the U.S. side wants a deal within the 90-day period and that currencies should reflect fundamentals. The Japanese yen at the moment weakening against the dollar. This is Bloomberg.
Take a look at, we continue to see gold hitting yet another fresh record high this week as that haven demand returns with the muted comments, or the muted sort of market reaction to the comments from Fed Chair Jay Powell being part of that narrative, but also, of course, the expansion of the scope of this tariff war into the likes of chips, and also expecting further moves when it comes to pharmaceuticals, when it comes to critical minerals measures as well. Dollar yen is holding pretty steady at this point. 142 is where we're trading, and also watching the Swissy there as well. Well, dozens of nations are looking for reductions or exemptions from US tariffs, and Bloomberg sources say the Trump administration is preparing to pressure them to curb trade with China in return. Let's bring up Bloomberg senior editor Derek Wallbank, also our China correspondent Min Lo for The View. And, Derek, we've been sort of talking about this encirclement strategy for a while now. How likely are we going to see this sort of being played out when it comes to negotiations with some of China's other trading partners?
Well, it's certainly something that the U.S. is thinking about and talking about, this idea that if the U.S. has some sort of action against China, such as the ones that they've taken, that China doesn't have an easy way to sort of off-ramp from that and get around it by taking goods that would have come to the United States and been subject to sanctions or similar and just sort of passing them off somewhere else. In a sense, they want to make sure that if there is some sort of consequence being levied out in the U.S. A way of thinking, that actually sticks. How they're going to do that remains to be a bit seen. There's certainly going to be some pressure put on as part of these bilateral trade talks with nations that have come forward seeking deals with the White House, but it's not immediately clear exactly what the White House is going to be asking for there. Certainly, there had been some talk, some questions rumbling about do you make these trade deals crafted in some way that kind of boxes China out? I would remind that we've been down that road at least once before. You will all remember, I think those of us of a certain vintage, the idea of the Trans-Pacific Partnership that was abandoned in 2016 and then became a separate trade deal that the U.S. isn't part of. So it's not likely that we're talking about some massive formation to box out China, but something that might be done in these bilateral sorts of ways.
I mean, and I wonder how that will sit with President Xi Jinping, right? We're finally getting perhaps some signals coming from Beijing that they're ready to get to the negotiating table, depending on some conditions, though.
Yeah, so I think one of the beef that China has with the U.S. is that the U.S., at least from the Chinese perception, seems to view China as a strategic threat and is using its policy to try to suppress China's modernization. And there's almost this frustration that no matter what China does, the U.S. is going to use these policies to curb China's rise. So some of the conditions that China has talked about include, number one, having the U.S. be willing to address some of the concerns, especially around the perception that it's trying to contain China, and also to address the core concern around Taiwan to maintain the status quo there. Other conditions include wanting the U.S. to appoint one point person who can oversee talks and who can speak on behalf of President Trump to clear up all that confusion and to have a consistent stand on what the U.S. position is. And China also prefers to have the two sides having these point persons from both sides overseeing talks that would eventually lead to a culmination in the leader-to-leader summit, rather than having Trump being involved in negotiations right from the get-go. And the third thing that China wants to see is also for the U.S. to show China some mutual respect, especially to rein in some of the disparaging remarks that has been made by some U.S. administration officials.
What are we seeing when it comes to the sentiment impact of these tariffs and the trade war in China?
Well, we are seeing definitely a big toll on China's consumer sentiment. There was a survey by Morgan Stanley saying about 44% of people fearing for their jobs or their family members' jobs. And also when it comes to consumers' confidence and the outlook for spending, that is the lowest, I think, since China opened up from the pandemic. Only 20% or so of people, 23%, expecting to spend more in the next quarter. And a lot of lack of I would say, a lot of pessimism around income growth as well. About 40% of people are worried that they will have salary cuts. Expectations of income growth has lessened to about 5.7% over the next 12 months, down about 50 basis points. So you can see clearly a hit to consumer confidence, the worry that the shortfall and the difficulty in selling Chinese goods through exports will lead to perhaps further deflationary pressures on China as well.
These trade negotiations so important for the economic outlook of so many countries. Derek, no wonder we're watching these trade negotiations between Washington and Tokyo very closely. The first ally that's actually gone to President Trump and trying to hash something out.
Well, look, Japan is at the top of the list of the countries that the White House would like to make a deal with. And Trump himself joined the trade talks today in a bit of a surprise. We're not quite sure exactly what came out of that, but Trump himself said there was big progress made. And look, he's the decider, so he's the one who gets to say exactly how this goes. But I do think that we're still waiting to see exactly what sort of concessions the United States is looking for, what Japan may be prepared to offer. But we're getting, as I say, not just off of Trump saying big progress has been made, but the Japanese negotiator who was there was telling that Trump said that Japan will be a top priority for these talks. So let's see how that one goes. The other one that I'm watching is Israel, which took a lot of action to try and remove its trade barriers to the United States. That happened before the reciprocal levies went out. Benjamin Netanyahu has been to the White House for talks with Trump directly. We still haven't gotten a movement there. The other place would be the United Kingdom, with Sir Keir Starmer and Trump having a better relationship than Trump has with the EU, and Trump and his officials have signaled that the UK maybe gets to be in line before the European Union does, even as the Italian Prime Minister is set to come to Washington and make her case. She may be the most Trump aligned in the European Union, or have one of the better relationships with Trump of any European Union leader. So those are all sort of key ones that I think I would be watching as we're going on specific to these reciprocal tariffs going forward.
Bloomberg's Derek Wallbank and Min Lo there with the latest on everything to do with these tariffs coming from the Trump administration, as we continue to watch the Japanese market very closely, especially the fluctuations with the Japanese yen, because we continue to hear from the chief Japan trade negotiator saying that they did not discuss currencies this time around, that the currency should actually reflect fundamentals. Well, that's a big question mark, right? Because we have been talking about the yen weakness and how that could actually lead to strength depending on what President Trump says. Akazawa now saying that they will continue discussions on the car tariffs. Remember, these still in place, even for allies like Japan, of 25%. Akazawa saying that he thinks that the U.S. understands, but he still thinks that Secretary Benson, that the finance minister of Japan, Kato, should be discussing currency soon, that he doesn't believe that Japan has actually tried to make the yen weaker. Of course, there's a lot to do with just global macroeconomics at this point, at a time when the Bank of Japan also is trying to raise rates. Akazawa saying that they've actually taken action in the past after speculative FX moves were seen in the markets. Remember just how much the finance ministry and the BOJ actually intervened in the markets in order to try to strengthen the currency given the recent historic weakness. Akazawa has also said that the U.S. and Japan will be talking within the month. This is Bloomberg.
Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored. We will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close.
Fed Chair Jerome Powell speaking at the Economic Club of Chicago, and that's the main point, right? I mean, if you're really emphasizing inflation, price stability for the health of the labor market, we were expecting, or markets were expecting, that perhaps labor health would be a little bit more important, which could potentially mean the Fed easing policy. But this emphasis again on inflation, perhaps leading the markets to think that the Fed is really in no rush to ease at this point. And actually, when the Chair Powell was asked about a Fed put, he answered no. So you can see why the markets were a little bit rattled in the overnight session. We saw haven assets rising. We're seeing a little bit of a rebound in the future space, though, Haidi.
Yeah, the rattling, the increased skepticism when it comes to U.S. assets is playing out favorably when it comes to Europe, as we know, right? This is the picture when it comes to the futures picture in Europe at the moment. A little bit of downside there for Euro Stoxx 50 futures there. We did see most losses being trimmed in the previous session on account of some optimism that potentially we could get further steps towards China-US trade talks there. But the Stoxx 600 is down about 5% in April. It also gained just about that much from January to March. But overall, we are seeing kind of the end of that America First trade really boosting a lot of European assets. Financial markets in Europe outperforming America's. The euro is now the strongest in about 3 years. German bonds are also beating treasuries by the most ever as well. So we continue to watch that real shift in dynamic with Europe emerging as being seen as a more resilient alternative place to invest. A lot of banks, the likes of Citi, Goldman's, as well as Vanguard, favouring European assets over US ones at the moment.
And perhaps really a real shift when it comes to the whole dynamic of global trade in the next few years, right? The World Trade Organization now slashing its forecast for merchandise trade this year. This with the soaring tariffs potentially upending global commerce. Total volumes expected to decline by 0.2%, which is almost 3 percentage points lower than the prior estimate without President Trump's trade war. It also warned of a sharper 1.5% tumble if the U.S. pushes ahead with higher reciprocal tariffs. Now, California Governor Gavin Newsom is suing President Trump over these tariffs. The state becomes the first to challenge the president's use of emergency powers to enact broad tariffs against Mexico, China, and Canada. Newsom now citing harm to California consumers and businesses, including those in agriculture and entertainment. Standing alone, the state would have the world's 5th largest economy. We have more ahead. This is Bloomberg.
We are just getting some breaking data crossing the Bloomberg when it comes to non-oil domestic exports coming through from Singapore. Of course, this is a key sort of canary in the gold mine set of data, particularly when it comes to just how externally vulnerable and open that Singapore economy is. We are seeing March electronics exports rising by 11.9% on year. Non-oil domestic exports overall, that headline number rising by 5.4%, really missing expectations of a gain of 13.6%. So that weakness really being seen there in just that headline data. We know that pharmaceuticals is also a key component when it comes to this set of data. That can be quite volatile at the best of times, and potentially we could also see more volatility when it comes to that, given that pharmaceuticals and drug exports are really one of the areas that the Trump administration is looking at for further tariffs and to target there as well. We have seen, of course, monetary policy being adjusted in Singapore as a reflection of these ongoing trade risks. Shery.
And talk about volatility. Take a look at these chip stocks. Of course, big movers at the moment after we saw Nvidia and the ASML wiping out over $200 billion. Remember, the U.S. government now applying a new ban on Nvidia chips, the H20 chip exports to China. AMD also saying that they will get a charge of as much as $800 million after new restrictions. ASML disappointing on earnings. So you can see the broad picture across Asia right now, a little bit mixed, but SK Hynix, a big supplier to Nvidia, down, leading those declines as well. We do have TSMC earnings out later today as well. IDC now saying that the wave of new U.S. tariffs will drive up technology prices, disrupt supply chains, and weaken global IT spending this year. Let's bring in Crawford, Prete, who's president at the advisory services and market intelligence firm. Great to have you with us here in the Tokyo studio. So I was talking about IT spending. I know that you've had some sort of scenario out there sort of trying to calculate the tariffs, but that was even before everything that we saw just in April.
Yeah, absolutely. So going into all of this, we started with about between 9 and 10% IT growth for 2025. That was our expectation. Now, as the tariffs started to roll out, we have looked at a downside scenario that it takes us down to about in the neighborhood of 5% growth. Now, that's primarily on incremental spend that would happen across hardware devices as well as infrastructure server devices. Now, going forward, our expectation is that the uncertainty at the market seeing is we're just not sure where we're going to land in terms of these tariffs. So I think we're probably going to land somewhere between that 9% and 5% growth because, again, if you're a CEO of one of these tech companies, what the market hates more than anything else is this uncertainty, right? And this is uncertainty in all capital letters. So do you say, I'm going to bring trade back, I'm going to bring manufacturing back to the U.S., start a factory, start building a factory, and then only to find out that the tariffs aren't actually real, and you end up with a $250 million or $1 billion hole in the ground in Texas, and then you go back to where you were? Or do you basically freeze and then decide once you get more clarity on the tariffs? So I think we're kind of in a wait-and-see position right now, but I think we can comfortably say, given AI investment, we're going to end up somewhere between that 9 and 5% growth. YT will likely see growth this year.
And that's exactly what's happening right now, right? Because with TSMC, for example, they pledged billions of dollars of investment in the U.S. They were not spared at all. And of course, President Trump talking about potential flexibility in the future. We're still not seeing that. What are we expecting out of earnings today?
Yeah, so today it's going to be all about the guidance. It's going to be, and I suspect what you're going to see in earnings is you're going to see scenarios. You're going to see, look, if tariffs actually get enacted in 90 days, then here is a reduced earnings scenario and a reduced demand scenario. If we see some kind of clarity in the next 90 days, then here's another scenario. And I suspect those scenarios and those gated scenarios will probably be the best that we'll get out of some of these companies because they just don't know going forward.
And you make the point of, right, like how quickly can you pivot to be able to build out this infrastructure, to make this investment commitment, and then can policy change all of a sudden? So I guess, you know, do we see kind of a paralysis when it comes to this sort of capex spending and decision making, or do you see commitments being made one way or another, and then that sort of commitment is going to actually be quite sticky, ongoing, regardless of what the US policy is?
Yeah, Heidi, that is a fantastic point. And I think what we're going to see is probably some kind of a deal cut here. And that deal, I suspect, could favor the companies that have made moves and made commitments back to the U.S. And so they may get some kind of a concession. Because if you don't have some kind of a deal get put into place, then what you're going to end up with is exactly you said. You're going to get paralysis, and we're going to get a freeze in the overall market. And that's terrible. That's going to lead to even more weakness in demand. And then you start putting things like global recession on the table, at least for IT going forward. And IT is so woven into the fabric of what we do on this planet that that could happen a lot faster than people think, which is why I think paralysis is not a sustainable scenario going forward.
You know, you write quite a bit about price sensitivity, and I do have sort of a curiosity in terms of the elasticity of pricing and demand across Asian markets, and how does that potentially play into some of the offerings that we're starting to see out of China, for example?
So I think when you look at price elasticity, there's, it's very obvious that when you get into some of the higher end gear, there's a lot more price elasticity that companies can afford to handle. So where we're going to see potentially, I think, pullbacks is when you start getting into a lot of the lower end devices, a lot of the phones, PC products, other kinds of hardware products that would be significantly affected. Obviously, low-cost parts that go in and support Nvidia chips. That's where that go into low-end consumer devices. That's where you see a lot of the pullback. When you start getting into a lot of the higher-end networking gear and you get into the high-end infrastructure gear, there I think we can absorb a little bit more. And then also there's a lot of places along the supply chain where you can absorb those price increases. That may be within the enterprise, that may be within the data center supplier, the hyperscaler, and so it becomes a little bit easier to eat. But I do think that the real vulnerability is in the low end of the market.
Were you expecting the United States to actually come out and try to close all of these loopholes when it came to the H20 chips from Nvidia? I mean, those were designed specifically to try to get around the export restrictions. And what could be next on the target list?
Well, so I think you're going to see where we're already starting to see it, right? Companies like AMD, right, are starting to look at taking charges. Potentially you could start seeing some of the high-performance memory companies starting to potentially be affected. But again, that's only speculation. To your point, I think this has got to be a negotiation because what you're doing with the H20, if you're the U.S. government, is there's sort of two modalities here. One modality is you're locking down access to a technology that you know can be used for AI implementations in China, and that was already on the table. There is no near-term substitute for that in China. But what you are doing is you're nudging places like companies like HiSilicon toward developing these products even faster. Now, is that going to happen next year? No, it's not going to happen next year. But could it happen in 3 years? Yes, it could. And so that's where I think that modality becomes really, really important, is the U.S. government has to think about the near term and they have to think about the long term. And that's why I think that this has got to be something that gets negotiated in the next 90 days.
Yeah, because all of this could eventually backfire, right?
Well, that's right.
Crawford, good to have you with us. Crawford, the president at IDC here joining us in Tokyo. Haidi.
Well, Shery, TSMC's views on those new restrictions curbing Nvidia H20 chip shipments to China will be in focus during its earnings call later on Thursday. Let's bring our Asia equities reporter Charlotte Yang. And, analyst optimism over TSMC is waning ahead of the company's quarterly results today. What are we hearing or watching out for and kind of listening for in terms of these ongoing tariff concerns?
Yeah, so while TSMC has reported the first quarter sales that came stronger than expected at 24%, what everybody, investors and analysts are watching is whether there will be any change to their full year guidance for this year, which earlier they said that they expect the sales for this year to grow by mid-20% in US dollars. So we're here, from JP Morgan saying that they expect the company to lower down that a bit, and Deutsche Bank expecting that it might just pull the full year sales outlook altogether. So I think and also what investors are watching is whether there will be any comments on that provide signals on how they assess the tariffs and also the H20 chip bans, as well as any clarity they can provide on the reported Intel and joint venture that some investors really don't like, and they're worried about that kind of investments. They question the strategic merits of that JV and what that kind of investments could mean for TSMC's longer term profitability. And just to provide you some data sets, on options, we're saying that the protections against further declines in the U.S. Shares are actually reached to the highest level since 2020 last week. And the proportion of analysts that now have a buy rating on TSMC's Taipei listed shares actually fell to the lowest level in 2 years. And the average price target has been cut about 9% this month since the Liberation Day tariffs. So we're seeing more cautious this time.
Yeah, I know that TSMC, for example, in the first quarter had some idiosyncratic issues like earthquake disruptions, but I wonder how much can we expect their comments to ripple throughout global and local Taiwan tech stocks as well?
I think the setup, because yesterday, the ASML's earnings really disappointed, and we saw a 4% decline, in the Philadelphia Semiconductor Index, and TSMC, the big one to report this week until Intel comes next week. So I think for global tech investors, what TSMC says and also provide guidance-wise is going to be a key factor to kind of help determine, where the tech stocks will perform. Especially now, after the recent sell-off, many of the evaluations actually now at a year's low level. And also for Taiwan, TSMC is the top member waiting on the TAIEX index. And also we've seen, a lot of the retail sentiment coming down a lot as the rally earlier this year, kind of a wind down. So what TSMC says will be really important for both the global tech stocks and also the Taiwan equity market locally.
Asia Equities reporter Charlotte Yang there as we continue to watch those tech names across Asia. Of course, we are also watching the weakness of the Japanese yen accelerating against the U.S. dollar after we heard from Japan's chief trade negotiator that currencies were not discussed this time. What's interesting, we're hearing from the Foreign Affairs Ministry here in Japan saying that Akazawa actually met with President Trump for 50 minutes. Interesting that currencies were not mentioned this time around, but we're expecting them to meet very soon. Akazawa saying that they will conduct the next negotiations within the month. This is Bloomberg.
Take a look at what we're watching when it comes to trading here in Australia. Of course, looking like it could be a quiet-ish sort of session given that we're going into that long weekend. But in focus, we're seeing a bit of upside there for BHP Group, up by 0.9%. We're also seeing Rio Tinto seeing some upside of close to 2% as we get the copper production numbers out of BHP really seeing a ramp up. Iron ore looking pretty steady there as well. Watching some of those other miners as well, given, of course, we're also seeing some uncertainty over the outlook on tariffs when it comes to critical minerals from the Trump administration. Let's bring in Bloomberg's metals and mining reporter, Paul-Alain, who joins us now from Melbourne. So, Paul, we've now had the two biggest mining companies in the world reporting their production results amid, of course, a backdrop of enormous uncertainty, potential for tariffs, potential for, secondary demand issues out of China. What did we hear?
Well, Rio Tinto was surprisingly muted in their response when they reported yesterday. However, BHP's CEO, Mike Henry, had more to say this morning. I'll quote him. He said, the implication of slower economic growth and a fragmented trading environment could be more significant. So he's pretty much warned that amid the tariff turmoil that we're seeing, it could trigger a global slowdown, economic slowdown, and hit trade flows. However, he did add that BHP is poised to benefit from a flight of quality Tier 1 assets. So what that essentially means is that BHP is a really low-cost producer and produces products like copper and iron ore that have higher margins. So he's expecting the business to be quite resilient while acknowledging that there could be a global slowdown amid this ongoing China-US trade war that we're starting to see.
And even the weather perhaps not cooperating, unseasonable weather causing a hit to shipments of iron ore?
Yes, indeed. The last 3 months up until March 31 was the most severe cyclone season that we've seen in Australia since the late 1990s. Rio Tinto was hit worst of all. Its production was down about 9%, or its shipments of iron ore was down about 9% on the previous, well, that was the worst quarter for it in production shipments since 2019, so 6 years. That's quite astounding. BHP, on the other hand, its iron ore ports further to the north and weren't as badly affected, though its coal mines in Queensland, where it mines coking coal used to make steel, were flooded by heavy rainfall. Vale is the third largest, or advised with Rio Tinto as the third largest iron ore producer, and it also experienced extreme weather in Brazil too. Something that has often been missed in this conversation, not about weather particularly, but just the general sort of landscape that we're in, is the amount of cost cutting that we're seeing across the board in the mining sector amid the geopolitical uncertainty. We have seen a refocus on capital spend. For BHP, it's cutting quite drastically across some areas. That said, Rio Tinto, by comparison, is growing its organic growth spending to $11 billion. That's the highest since 2013.
We've seen critical minerals in the headlines, namely because it looks like this is kind of the new area of the expansion of the scope of tariffs from the Trump administration, right? We know that China has more than 70%. We know that Australia has a smaller amount, but still some. Is there an opportunity here?
There's a huge opportunity for Australia, and one that, as Australia heads to the election, is focused on. However, you know, whether it's having the mined products, rare earths, as rare as they sound, are actually quite common. The IP in how to process, how to refine them is really key, and China has been doing this for 30 years. So they are decades ahead of the West. Out of the 17 rare earth elements, 7 of them are now subject to export controls. And we ran a brilliant feature on that, an explainer on the Bloomberg terminal and on the Bloomberg website, which you can read. China's monopoly, I mean, it's about 90% in total of supply globally. They really have a stranglehold. The West has been trying to break this stranglehold for years. Now, in the midst of a trade war, China's weaponising it. If you'd asked me what those 17 rare earth elements were a year ago, I wouldn't be able to tell you what, say, terbium is. And terbium is a rare earth element that's used to ensure the colour on our screens on our iPhones, and is also used in missiles. You know, there's a lot of these random rare earth elements that people have never heard about suddenly coming to the fore. So it's certainly an interesting time. BHP and Rio Tinto, just to be clear, don't produce rare earths. They're focused on copper. They're focused on lithium and iron ore, because those are areas of scale.
Paul-Alain Hunt, we'll have to leave this conversation here because we are getting breaking news out of South Korea. The Bank of Korea now leaving policy unchanged at 2.75% as expected by the majority of economists that Bloomberg surveyed. The expectation was for a hold for this time around. The Bank of Korea cut rates back in February, and of course we have seen stabilizing the currency as one of the priorities for not only the government, but the Bank of Korea has been watching the won very closely. The Korean won has strengthened in the last couple of weeks, but remember, even last week just temporarily fell towards that 14.90 level to the dollar, the weakest level in 16 years. It was actually Asia's weakest performer in 2024. So 15 of the 24 economists that we had surveyed had expected really no change in the Bank of Korea decision today. Haidi, of course, financial stability concerns, as I mentioned, the Korean won, but also a potentially hot housing market, that it's always a threat and a risk for the economy still at play.
It is a challenging balancing act, isn't it? Because if you take a look at the reasoning from the 9 economists that we surveyed that it predicted a cut of 25 basis points, they would be citing the need to cushion this, you know, extremely export vulnerable, reliant economy against the impact of tariffs, to revive activity that was really sapped by months of what we've seen, and you've seen firsthand as that political malaise as well. But we're seeing that caution from the BOK, leaving the policy rate unchanged at 2.75%. Let's bring our executive editor for Asia markets, Paul Dobson. So we have the element of needing to support the won here as well. What do you make of this decision, particularly in light of clearly a great deal of uncertainty for central banks? You just have to kind of listen to the caution being expressed by the Fed chair overnight for an indication of that.
Yeah, I think all of the central banks at the moment in that period of uncertainty, right, trying to predict a future well, they're telling us very explicitly they can't really discern. But what we did hear, at least from Powell, is, you know, this tariff impact is going to be bigger than previously expected, and express those concerns about inflation. So I think that's going to be on all of the central banks' minds and agendas going forwards, and it does make that policy outlook harder to predict, and therefore if you're trading currencies or bonds, it also makes your job a lot more difficult.
A lot more difficult for the Bank of Korea at a time, as Haidi alluded to earlier, political instability. They just ousted their president. They have elections coming up. At the same time, so trade exposed. So we are seeing their exports now starting to slow down. And then you have the Bank of Korea also dealing with unexpected acceleration of inflation just in the month of March. Talk to us about these risks, especially in the markets with the Korean won also pressured.
Yeah. Well, so we saw the won has been very volatile. It got pushed to extremely weak levels and then rebounded extremely strongly last week as well. That level of volatility makes the investment outlook across asset classes more difficult. I think South Korea has that extra layer of doubt in terms of technology exports, because that's such an important part of the market and the economy. You know, how levels of tariffs might impact the economy and the economic outlook. Whether, you know, the US will insist, as we've been hearing, that it tries to join efforts to shut China out of various parts of the market as well, which could again be damaging or harmful for the economy. And you know, as we were saying, the exchange rate itself as well. So I think that they have all of these things to take into consideration. Best thing I would say probably for most central bankers to do would be to sit on their hands and wait until the dust clears a little bit. And again, going back to Powell, I think that's what he's saying. It's, you know, wait and see mode for the world's most important central bank. And so a lot of the others will probably want to take their cue from what's going on there.
Our executive editor on Asia markets, Paul Dobson, there with a reaction to the BOK sounding pat as expected. This is a picture when it comes to futures trading across the US. We're seeing a bit of an uptick when it comes to the Nasdaq at the moment, despite what was a very challenging session again, particularly when it comes to the chip makers. These curbs on Nvidia when it comes to its China product, ASML, as they're warning, really spurring that global tech stock rout that does continue with some of that weakness that we see today. SMA futures also seeing a little bit of upside there. We're seeing TAIEX futures softer, though, given that we're also looking at TSMC and some of the surrounding sort of narrative, the first quarter results, but also the details and its view in the conference call expected today as well. FTSE A50 China futures looking a little bit softer too, Shery.
We continue to watch the currency space with the Korean won holding steady. Of course, we talked about that rally recently to the strongest level since November, but then at the same time falling to the weakest level in 16 years just last week. So you are seeing a little bit of downside today, but not by that much. And you're seeing the Japanese yen also holding on to those declines after we heard from the trade negotiator that the US and Japan did not necessarily discuss currencies this time around. That's it from the Asia trade. Our markets coverage continues. The China show is next. This is Bloomberg.